Okay. All right, we're going. So, welcome to the channel, That Mortgage Show. Mortgages get my blood pumping. It is what I choose to spend my life doing. We're going to get into mortgage rates, where they've been, where they going, look at some articles, talk about home buying trends, look into 2025. So, we're going to start off by doing something that I do many times a day, but it's definitely how I start the day. So, I'm going to show you what I look at. So, this is mortgage-backed securities. You can see here, these mortgage-backed securities, the price of these rise and fall. We want the price of this to go up. We want the price of the 5.5 coupon to go up. If the price goes up, then the yield comes down. Mortgage rates come down. So you can see that they're up slightly over the last day or so. The next thing that we look at is the 10-year Treasury. We want the 10-year Treasury to come down. If the 10-year Treasury comes down, that's a good indication for mortgage rates. And then we can always just go down here and look at some average offered mortgage rates. So you get the 30-year fixed at 7.06, really unchanged. You've got the FHA at 6.3 and government or VA at 6.4. So that's the first thing I do is I jump over there and look at this. You like to see green. There's some green on the charts, and rates have gotten a little bit better over the last 2 days. But over the last month, they've gotten much, much worse. So it's not what we're looking for. It's not what we're hoping for. We're ending 2024 with mortgage rates higher than they were 12 months ago. 12 months ago, mortgage rates were about 6.6 average offered rate, 6.6. Today, they're over 7, just slightly over 7. Average rate on 30-year mortgage climbs to 6.85%, highest since July, as bond yields keep rising. So, this is a little outdated. Rates have actually gotten worse. So I just wanted to read this headline to give you an idea that they are the highest since July, and it's higher today than when this article was published. One thing I wanted to point out in the article is bond yields climbed last week after the Federal Reserve signaled that they will likely deliver fewer rate cuts next year. So Jerome Powell talked last week, and yes, they lowered the rate, but he hinted at maybe lowering the rate twice next year. I think it was as high as 4 or 5 times initially. So, that's not a great sign for interest rates, and they're blaming it on recent inflation. They're saying inflation's kind of sticking around, even though the Federal Reserve said that they had it beat. They said they had to beat inflation. We're looking at jobs now. Inflation's beat, but now I guess inflation's back. We'll see. Things change on a dime. But they're blaming inflation, and they're blaming Trump's tariffs. They think that Trump's tariffs is going to exacerbate inflation. So, quote from the article, the biggest wild card for mortgage rates next year is whether President-elect Donald Trump's policy initiatives will contribute to higher inflation and swell the national debt. Well, the national debt has gone up. I don't know, what is it, 12 trillion in the last 4 years or something like that? Okay, so this is impromptu. I wasn't planning on sharing this, but you're looking at it with me. So here we have the national debt year over year. So in the last 4 years, we've got 28 billion, this is billions, 28 billion, 30 billion, 33 billion, and then this year we've added 2 trillion to the national debt. So, the Federal Reserve is worried about, what was that quote? The biggest wild card is whether President-elect Donald Trump's policies and initiatives will contribute to higher inflation and swell national debt. So that's what they're worried about. Well, 28 billion, 30 billion, 33 billion, every one of those years, and then 2 trillion, every one of the past 4 years, addition to the national debt was higher than when Trump was in. So maybe inflation's so bad because we've been adding to the national deficit hasn't been brought up in the last 4 years as a contributing factor to inflation, but they're worried that the addition to Trump's addition to the national debt is going to cause inflation. Maybe printing money and sending it all over the world devalues the dollar, and that's why inflation's happening. Call a spade, you know? So just to recap that part, mortgage rates end the year higher, bond yields continue to climb, set off by the Federal Reserve signaling fewer 2025 rate cuts than initially planned. The Fed and traders are claiming sticky inflation, and the fear of Trump tariffs exacerbating inflation is the issue. Next, let's look at some mortgage rate predictions for 2025. Some predictions from major institutions like Fannie Mae, Mortgage Brokers Bankers Association, real estate economists, and other analysis. So Fannie Mae forecasts that rates should settle in about 5.9% by mid-2025. I'd be cool with that. Mortgage Bankers Association has rates averaging between 6.4 and 6.6. So get back to where we were end of last year. And real estate economists, they approximate 6.2 to 6.3, and some of the other analysts have rates between 5.8 and 6%. So look, any one of those is better than where we are right now. And these projections, they change all the time. What I would say is, if you're in process, definitely talk to somebody who is looking at this stuff every day and can just advise you. It's usually best to lock sooner rather than later. Lock when you can. A bird in the hand is worth two in the bush, right? You'd rather have your interest rate, you'd rather be locked in and safe and guarded against rates going up. You'll be more upset if you're not locked and rates go up than if you are locked and rates go down, I think. But if you're in process, definitely be having these conversations with your loan officer, and your loan officer should be able to articulate all of this in a understandable way. If they can't, call me. All right, so some key takeaways from this article are the predicted average rate is at 6.8%. Rate range predictions range from 6.6 to 7. Experts forecast, so institutions like Fannie Mae and Freddie Mac, Mortgage Bankers Association, indicate trends supporting these predictions. And market dynamics, many factors including inflation, Fed policies, influence mortgage rates, impacting home buying and selling decisions. So, yeah, I mean, many factors are going to influence mortgage rates, and we're just going to have to see what happens. If some reports come out and inflation isn't as bad, or Trump gets in office and he's not adding to the deficit or levying crazy tariffs, or the tariffs aren't impacting inflation like people think, maybe all these places will reassess. So you just got to stay tuned, and we'll see where things go. It's no secret that the last couple of years have been difficult for the housing market, difficult for home buyers, difficult for real estate agents, difficult for mortgage folks. Look, mortgage professionals, loan officers, there was something like 400,000 of them in 2021, people in my position. Now there's 98,000. So they've gotten out of the business. The business is, there's just a smaller piece of the pie for people to grab for real estate and mortgages. And then it's equally as hard for home buyers. If you want to buy a house and you're in the market, it hasn't been easy. That's no secret. So let's look to some housing market trends going into the new year, according to National Association of Realtors, Zillow, Redfin. So a quote here from National Association of Realtors Chief Economist and Senior Vice President of Research, Lawrence Yun. Home buyers will have more success next year. Quote, let's hope for it. The worst of the affordability challenges are over, and as more inventory, stable mortgage rates, and continued job and income growth pave the way for Americans to achieve home ownership. Look, Lawrence, I hope you're right. That would be great. If there was more inventory, I think that would solve a lot of the issues. I think that might be even more important than interest rate. I think interest rate, people will budget, they'll change their budget, and they will adapt. Payment. If you can't afford it, you got to just look at a cheaper house. If there's more on the inventory, you can find things in your price range. I really think that inventory is probably a bigger problem than interest rate. But interest rate is contributing to the lack of inventory because people have 3%, 2.75, so they're not selling. It's a really weird, really sticky situation, kind of like a double-edged sword, one of those deals. So let's look at an article here. At hotspots to watch in 2025. Home buyers will have more success next year. So they threw in that quote from Lawrence Yun. And let's take a look. Let's see what some of these places are. So let's run through the top 10 here. We got Boston, the Carolinas, a lot of job growth in the Carolinas. Charlotte, Greenville, South Carolina, Kansas City, Grand Rapids. Hey man, you might want to move to Grand Rapids. So we've got Boston, Charlotte, Grand Rapids, Greenville, Hartford, Indianapolis, Kansas City, Knoxville, Phoenix, and San Antonio. So pretty wide range of cities there. You got the Northeast, you got the Southeast, you got the just like the South, Midwest, South, Southwest. Really good spread there. So, take your pick. You're looking to invest, you're looking to move. Maybe you go out to Grand Rapids. So those are the top 10 housing markets to watch in 2025. I guess they're thinking that those places will have an influx of buyers, whether it be because home values are competitive, there's more inventory, or there is job growth in that location. From Better Homes and Garden, I wanted to share 5 home buying trends that will define 2025. So according to this article, we have real estate experts predict that the home buying market in 2025 will be defined by several key trends, including longer time on the market for homes, a decrease in home price, high demand for move-in ready homes, economic uncertainty influencing buying behavior, and potential for decreased interest rates making home purchases more affordable. So, it's a fun article, and I don't know how correct they are with some of these. So, if we see houses on the market for longer, we can assume that sellers will get eager to sell and they'll lower the price. Higher demand for move-in ready homes. People are kind of stretching their budget with interest rates, and they don't want to go into a place where they have to put money into it after the fact. And then economic uncertainty influencing buyer behavior. That's going to be a trend. People have been worried about economic uncertainty forever. I think just economics are uncertain. So if you get any use out of this video and you want to subscribe to the YouTube channel, that would be great. Definitely been working hard at this. And on my YouTube channel, you can watch all of our content. We've got tons of shorts. We've got our long form stuff, our weekly show. And then we also have, ways to contact us. So this is me and Al's channel. Al will be on Friday for a show. But also we have here, we've got Apply Now. We've got Book a Call. You want to have a call, talk about purchase, refi, whatever you got going on, down payment, first timer, incentive programs. We got our social media and a link to some reviews. So, yeah, go check it out. If you're just seeing this, go check out the channel. Like and subscribe. Yeah, thanks for sticking it out, and Happy New Year. Happy New Year.